Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 334th VideoCast podcast for the week ending March 11th, 2026. We got a lot of great stuff to cover today, but as always, family first. It was another weekend of water polo for Mimi and Annabelle. Both girls crushed it. Annabelle became a ball-stealing machine. She scored 7 goals this weekend from steals. Annabelle also learned that she is a top 3 finalist for the Orca Award, which is essentially the ESPYs of swimming. She was nominated for 11-year-old Swimmer of the Year and has been invited to the Orca Awards ceremony in Florida next month to meet college coaches, national team members, and fellow nominees from around the nation. Mimi had a great weekend as well. We don't have any family photos this week, but we got this family of ducks, a mama with her 6 babies that held us up playing on Saturday morning, but we had a wonderful time. And then this was from today. We'll cover that in a minute. And we'll just cover a couple of their goals today from the weekend. This one was... All right, that was Mimi from set, and we'll get one of Annabelle's breakaways. Nice steal and swim. Boom. So that was that. And then this afternoon, we got the news that Papa John's got a takeout offer from Earth Capital, which is backed by the Qatari Sheikh Mohammed bin Abdullah Al Tahini. And you can see my tweet at Hedge Fund Tips is the handle on x.com. I said, "Dear Sheikh Mohammed bin Abdullah Al Thani from Earth Capital, thank you for your offer of $47 per share for our meaningful holding of shares in PZZA, Papa John's, but you got it backwards. Anything below $74 is unacceptable. The turnaround has just begun, and I will not agree to have all the upside stolen from me and from my clients," and tagged Papa John's management, etc. So look, we're very flattered by the offer. This group also owns about 10% of the stock. They offered $60 late last year with an Apollo backing. This time they offered $47 with Brookstone, with some other backing. And the point of the fact of the matter is the business has become more valuable, not less valuable. So not 47, 74, and we'll talk. Stock was up big today, and we're happy for that. But like GXO, it was not the right move. The key is we get in these things for doubles, not to make 20, 30, 40%. So that's that. The Qatari Fund article. I had the beautiful pleasure, speaking of timeliness, to go on Fox Business with Varney & Co. with Stuart Varney. Thanks to Stuart and Maggie Edwards for having me on. And I happened to be talking not only about Buy the Bombs, which you'll hear about, but two of my picks, and one was Papa John's. I was bragging around about the turnaround and the fact that they are trying to get a Michelin star rating on their brand new pan pizza, which is phenomenal, by the way. Get it with the pepperoni. It's got this garlic parmesan crust that makes it crispy, delicious. We'll see if they get the Michelin star or not, but you can listen in here.
On 22, Tom Hayes joins me now. Oil back to $90 a barrel after hitting almost $120 Monday. That's after a briefing from the Pentagon. We had a briefing from the Pentagon this morning, and frankly, Tom, I think it looks like we're winning. Does that mean the end of very heavy selling?
From a stock market, we are winning, by the way, Stu. From a stock, are you getting tired of how much you're winning? So from a stock market standpoint, this event is over when ships pass through the Strait of Hormuz, even if bombing continues for many days, weeks, or months thereafter. And what we found yesterday is there are some ships getting through beyond the Iranian ships. There was a Greek tanker that got through, and the way they're getting through is by turning off the transponders so they cannot be picked up on radar. And then when they're miles and miles through, the transponders go back up and they're picked back up. So I think that's number one. Number two, there's a G7 meeting this morning where they're going to release 300 to 400 million barrels of reserves. They've released some of the sanctions on Russia to get some more supply. So what the market's telling you yesterday and what the market's telling you this morning is that things are starting to flow, and there is a level of belief that what Trump said he's going to stick with, which is if you mess with the ships in the strait, you're going to see death, fire, and fury 20 times worse than you've ever seen before. Also known as the Strait of Hormuz will become the Strait of America very quickly if you mess with the ships.
I read your stuff and you say, buy the bombs. Okay. What does that mean and what are you buying? You've got 1 minute.
Okay. Well, there have been 41 overseas military strikes since World War II. On average, 1 month later, the market's up 1%, 3 months, it's up 3%, 6 months, it's up 8%, and 12 months later, on average, the stock market's up 12.93%. So we're using these opportunities of dislocation to buy good companies at great prices, like Advance Auto Parts, which is a turnaround story. The average car on the road is 14 years old. They've got a new CEO that shut down all the non-profitable stores. He's already expanding into growth, paid down debt. That's on its way back to new levels. And then, of course, you have the turnaround story with Papa John's, the pizza tracker outside Washington. Every time there's a big event, people track the pizza as well. Papa John's is recovering. They've got the former CEO who turned around Wendy's in the mix, that you get a 5% dividend yield while you wait. Again, he's refranchising the company-owned stores, taking costs out of the business, and that business is starting to recover. As a matter of fact, they have a pan pizza that they're trying to get a Michelin star for. So we'll see what happens in coming months.
Oh, that's a good story. I'll take that one. Good. I'm just watching the price of oil, $88 a barrel. Tom, thanks a lot for joining us. I appreciate it always. Now listen to what President Trump said about making America great again.
And we're back. And then I had the pleasure on Monday, I did a favor for a friend of mine, Zoltan Saranyi, to go on his new show, Stock Trader Network, with Joel Elkinen. And this proved to be a really phenomenal interview. Joel did a great job asking a lot of good questions. You can see in the beginning. This was, by the way, when the market was down about 1,000 points on Monday morning, right in the middle of it. And he was excessively shocked that I was bullish. But he has some really important questions at the end. So this is a real valuable 20-minute interview that was completely unexpected, and I'm very grateful for. So thanks to Zoltan, and Joel will listen in here.
Okay. Good morning, traders and investors. A wild day here on Wall Street. Joel Elkinen here, joined by Tom Hayes, Great Hill Capital hedge fund manager. Tom, how you doing today?
I'm doing great, Joel. Thanks for having me on today.
Yeah, what a day. What a day to have you on. Did I pick a good day or not?
Well, let's get to it because we got some work to do today. We want to be in the market buying some stocks.
Okay. All right. Well, let's get right to it. And I'm going to give you some lightning round questions here. You can give me your thoughts, and we can get some pull up charts afterwards. Tom, is the AI boom still in the early innings? Are investors pricing in too much too fast?
We are mid innings. I think we are going to. I think the market, X the war, our base case was the market was set up for a violent counter trend rally in software and tech and all the things that got smashed in the last 3 months. We're going to need some resolution in the Iran situation in order to see that violent counter trend rally. But I think that will be sold into mid-year. If we do, in fact, get the bounce, I think it will be sold going into the election. I expect some weakness. We've been calling for mid-year weakness, not early year weakness. So let's see how this Iran thing plays out. But if we get that bounce in software in particular, which could be very, very violent, I think it's going to be sold by institutions who were trapped in the trade. So you'll get a couple months of strength and then probably some weakness into the fall in software. That said, I do think there are going to be tremendous opportunities to buy some of that tech, some of that software as we get into the fall, when no one is interested in buying the dip. I think prior to this Iranian situation, there were a lot of players looking to buy the software dip. And I think when you want to start to get interested will be sometime later in the year when the AI trade is perceived to be over, when one or two hyperscalers comes out and says, we're cutting CapEx. That will be the time for the second leg of the multi-year rally as the technology continues to enhance businesses, and we'll start to see a return on invested capital probably in the next year and a half or so.
Going a little bit farther out. So what about the hope of our S&P heavy-weighted mega cap, right? It took us there. It took us to the promised land. Microsoft, one of the first ones to fall. We all know that what that category that falls in. NVIDIA, we were waiting for NVIDIA to break out over 194, ready to take the S&P over to over 7,000, that major breakout that we needed. But of course, going back to the war here, the market has gone back to the mega cap so many times over the years. Is the song going to remain the same there?
In the short term, once there's some green or yellow light in the Iran situation, I think tech is what gets bid. However, coming into this year, we have a podcast. It's number one in the hedge fund category, which is a small category, but it's called Hedge Fund Tips with Tom Hayes. Our base case was that indices and passive investors would be underwhelmed with their performance in 2026. That's been the case. If you look at equal weight has outperformed cap weighted by 500 basis points. So I think that theme is going to persist because I think that any short-term aggressive bounce in tech over the next couple of months will probably be faded. And to your point, the indices are aggressively weighted with tech. So our base case had been passive indices, cap-weighted indices, mid-single digits for 2026, and the huge amounts of money would be made under the surface in individual stocks. And that was, in fact, the case for the first, call it 7 weeks of the year. Everything else was dramatically outperforming. I think that theme starts to revisit, in coming months as we get some clarity on what's going on. And on that basis, the thesis remains the same. The other thing to keep in mind is historically, you get an 18.3% on average correction in a midterm election year. Our view was that was unlikely. We were thinking maybe 10 light teens, 10 to 15%, just over 10% would have been normal. And the reason being, because of all the stimulus you had, and because we actually pulled forward a lot of 20% corrections. You usually get it every 3.5 to 4 years. We got 3 in 6 years. So then that may very well still be the case. I think we're going to be surprised at where the pain points are and how this gets alleviated over the next couple days, couple weeks. We're already seeing oil kind of roll back over this morning, back below 100. So G7 meeting coming up, talk about them releasing oil reserves. But at the end of the day, we need to see more ships going through the Strait of Hormuz. There was a Greek ship that turned off their signals overnight and they got through without a problem. So we'll see if we can get some more ships going through.
How about any ships, right? Going through there right now.
Yeah. Well, the Iranian ships are going through and one Greek ship has gone through. So let's see if that starts something.
So the market focuses on different things at different times, right? And of course, during earnings season, you have the fundamentals of companies coming out. we're kind of past the mega cap coming into the retail earnings season. You also have your economic data that comes out, and the street was not pleased with the jobs number that we got on Friday. We have more economic data coming out this week with the CPI, also the PCE. But what this all molds into is interest rates in the Fed. They're the pickle now. We know Jerome is going to be out the door soon. We hope, or Trump is banking on more of a dove coming in here. In your investment thesis here right now, where are you placing emphasis on the Fed and interest rates?
Yeah, I mean, the biggest part about this war, more than anything else, is the impact of what it will or will not allow the Fed to do come May when Warsh takes power. I mean, at the end of the day, if you have elevated oil, that's an input cost for a lot of goods. Okay, forget the price at the pump because they use a different, the PCE, they use X energy and all that stuff, but it doesn't matter. It flows through basically every product we use. So what you're seeing in private credit markets, which is a huge concern, and companies that have debt on their balance sheet, is a fear over an inability to refinance or extend and pretend, because if inflation is high, you will not get cuts. If you don't get cuts, a lot of these companies can't refinance. It stalls investment. It makes balance sheets more vulnerable, which is why you're seeing in the short term small caps get hammered. If this gets resolved and you see the weakness in the job numbers, and there was some talk about whether that was weather related and blah blah blah, but if you see that general slowing in employment and oil comes off the boil because ships start getting through and they release oil reserves, and Trump declares victory or Iran unconditionally surrenders, what you're going to see is the private credit fears in the short term are going to be alleviated, and the narrative is going to change from really bad loans, fake mark-to-markets, to, oh, this was idiosyncratic, this was a few companies, this is not a big deal, rates are going lower, they can refinance. And that which I think is going to be a problem, private credit, and we've been talking about it for 6 months, is going to get kicked down the road by 3 to 5 years if Warsh is successful in doing what he wants to do, which is tighten liquidity by selling off assets on the balance sheet and offset that by cutting rates aggressively. And I think if he can find that balance and some type of resolution in Iran will enable him to do that, I think we could be back in a Goldilocks scenario where rates are coming down, companies are refinancing, credit is flowing, private credit is delayed, extend and pretend problem for another day, and we're off to the races. And that alleviates housing, which is also dependent on rates. You get housing working, 16% of GDP, you're going to get a lot of high-paying jobs, and this economy is going to hum. And then when Besant's talking about 4 to 5% real GDP and 8% nominal, he doesn't sound like a fantasy. It starts to become closer to a reality.
So being a hedge fund, you trade long, you trade short, you trade both sides of the market. So it doesn't sound like you're looking at any a lot of aggressive longs, but do you have any shorts out there that you've put on in anticipation of this, and areas that you may be covering, or shorts that maybe you're pressing in this market environment?
Yeah, we tend to run a concentrated portfolio of 8 to 12 companies. Our average holding period is 3 years. Okay. So we're looking at opportunities like this to be buyers, not sellers. We don't sell in the hole, we buy in the hole. So this is where we've made our knitting. This is what has enabled us to build a nice position and service our clients, is that we can ignore the short-term noise in exchange for the long-term opportunity, and that's exactly what we're seeing right now in the market, is just a number of tremendous companies that have gone on sale that we can slowly add each day. Every time we have a red day in a situation like this, we can add more stock. so that if and when we wake up to a tweet, it's interesting. This is very similar to last April. And I know a lot of people will push back and say, no, this is nothing like last April. But last April was started with a tweet and ended with a tweet. And I think that this war is not dissimilar in that it'll be over when Trump says it's over, and it'll be over when and that may be Iran blinking, because it's very hard to defend yourself with your military decimated and no navy and et cetera, or it will be over when Trump declares victory. We leveled their military. They're no longer a threat. Their nuclear sites are a wasteland. Onward and upward, pat on my back, and we move forward. So what you don't want to do is get caught short overnight and you get that tweet and you're screwed. Last night was hysteria, okay, on X, okay? People were flipping out. I put out a tweet. I said, this will be over. This stock market event, not this war, the stock market event will be over the minute you get a ship or two escorted or unescorted through the Strait of Hormuz. So they could keep fighting for the next 3 years, but if ships are going through the Strait of Hormuz, the stock market will be up, period, over and out. That doesn't belittle the sad loss of lives and all the terrible things that go along with war. But from a stock market standpoint, those ships flow through and this is over, okay? And you'll be at new highs above 7,000. And we can't know when. So we just have to know if, but in the interim, we look at each company on a company by company basis and we say, okay, if this lasts 1 month, 3 months, 6 months, what will be the impact on this company's ability to generate free cash flow? So if you own Coca-Cola, okay, we don't own Coca-Cola, but if you own Coca-Cola, are you going to drink fewer cans of Diet Coke today, Joel, because there's a war going on in Iran?
How'd you know I drank Diet Coke instead of regular Coke?
Because all the smart people drink Diet Coke. It's just the way it goes. It's an affliction that I suffer from as well.
I gotta alert our investors here that earlier you worked with Cornwell Capital Management.
Yep.
A known firm for predicting the 2008 credit crisis. I won't ask you anything in particular about Mr. Burry because he's a very controversial figure here. But give us some of the similarities in the because you sound bullish to me. You sound like this shall pass.
Yeah.
So give us some of the similarities and some of the differences between what we're seeing in the 2008 financial crisis and now.
That was a debt crisis. So right now, household balance sheets are near the healthiest that they've been in 40 some odd years. Corporate balance sheets on balance are healthier than they've been in years. They refinanced a lot during COVID when money was free. That's the ones that are more vulnerable are the small caps, which, we got to get through these private credit fears. And that's just a function of getting through the fear of inflation. So this is tweet created, tweet ended versus 80 years of buildup of debt that needed to be flushed out by the system. It's a completely different game. It's comparing apples to oranges. Now you can have the clowns on Twitter, saying this is World War III, and maybe they'll be right. But what I found is the end of the world only comes once. And if it's now, the last thing we have to worry about is our stocks. And if it's not now, then if you're not buying in periods like this on a selective basis on each red day, then you're just missing an opportunity to outperform. Everyone's taught in college, efficient market theory, blah, blah, blah. So if that's true, let's assume that all the professors are correct who manage $0. Then the only way to actually outperform is to buy during periods of forced selling and dislocation. And if you do that, if you're not a seller in the hole, you're actually a buyer in the hole of good cash generative businesses, boring businesses. You don't have to predict who's going to cure cancer. You don't have to predict who's going to win the AI race. But, if you get a company that, makes Planters peanuts, or if you get a company that makes backup generators for AI data centers and for the largest home standby generator company in the world, if you get a company that sells auto parts, these type of things you don't have to think hard about when the margin of safety is great, served up by exogenous events that have no meaningful direct impact on the market. Look, if we go into World War III, it's going to have an impact on every company's ability to generate cash flow. But at that point, we're worried about different things than your short-term mark-to-market on the portfolio, which, by the way, is the number one reason you don't want to have massive amounts of margin. So something to keep in mind.
That's something that we stress as well. So if we rule out World War III, okay, and we rule out a major bank crisis, is there another risk in the market? So sometimes it's the risk that you don't know about, the unexpected risk. Is there another unexpected risk over the 6 to 12 months that might shift your investment thesis?
I think you're in it. I mean, I can count the number of people on one hand who predicted we were going to have a war in Iran starting last week, and it's called zero. So, they'll all in hindsight say, I saw this coming and blah, 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 but no one did. So, you can't position a portfolio. And the people who position their portfolios as if some black swan is going to happen every quarter have no money. They sound smart because they're always negative, and they have no money because the market goes up 70% of the time. So my suggestion is buy good companies on low margin, ride through this short-term noise, and you'll be really do exceptionally well over time. As far as predicting what I don't know that I don't know, that's a fool's business. What I focus on is what I can control. And what I can control is buying business with durable, predictable cash flows over many years, and in most cases in our portfolio, many decades, and seeing them through many geopolitical events, war events, credit cycle events, recession events. And if they can withstand those, they can withstand some short-term headlines, even if we have to bear a short-term mark-to-market against us.
That was a fantastic answer there. I guess I'll be waiting for a tweet or a truth that the war is over. It's a great time to buy stocks.
Exactly. His market predictions have been pretty damn good over the years. If you took them seriously, so we'll see when that comes. I think he's willing to bear a little bit more pain to get this threat under control, but that'll just create a little bit more opportunity, a couple more days of opportunity for us to be in the market buying good companies at great prices.
All right. Good companies at reasonable valuations. That's what we look for on the Stock Trader Network. We've been lucky enough to have Thomas Hayes, American hedge fund manager, founder of Great Hill Capital. For a pretty young-looking guy there, you seem to have a lot of experience in the market. So you've been through a couple different of these situations before. You're using your analytics to give intelligent and long-term investment ideas on the markets. We really appreciate you, Thomas, and we will get you back on we're going to get you on Pre-Market Prep and the Stock Trader Network. I do have one question popping in from JJ. I got two questions before I let you go. Home builders.
Yes.
Any thoughts on home builders?
Yeah, I don't want to play the home builders directly. I believe in the theme because we've got the largest portion of our population is the millennials, 34, 35, want to start family formation, housing formation. The problem you're going to see is when that game is on, when rates go down, you're going to see an abundance of supply start to be put on the market by home builders. It's going to be a race to the bottom in terms of margins. What I want to do is be in the arms dealing business, not the warring faction business. Arms dealing meaning we own QXO, which is Brad Jacobs' building supply company roll-up. We own Generac, which is the home leader in home standby generators, the Kleenex of home standby generators, 75% of the market. When rates come down and building volumes go up, that's a leverage play on that. And then Stanley Black & Decker, you're going to need the tools to build the houses. DeWalt, Stanley, Craftsman, Black & Decker, et cetera. So we prefer to play those companies that have immense operating leverage tied to the increase in volumes in building, which will be a function of rates, as Warsh gets in and some of these short-term headlines calm down.
That's a great answer to that. And then the final question here from JJ. This is a tough one. And we all talk about buying good companies at good valuations, right? That's the mantra. But when you have so much disruption, right? I mean, that's with Microsoft. Like they're probably still a good company. They're probably come down to a reasonable valuation, but the disruption that coming to software. And I know you gave us, your scenario in that, but man, doesn't that throw a fly in the ointment here when you're trying to use that common sense analysis of buying good companies at reasonable valuations?
Yeah, we avoid software, but the theme is correct. And what, I always say, we look for doubles and triples over 3 to 5 years. Okay. So that's our knitting. We're not looking for 100 baggers. We're not looking to predict the future. And to do that, price is what you pay, value is what you get. Price matters. So unless you're buying stocks in periods like this, which happen every single year, we get on average a 10% plus correction. Okay. If you look back through history, I think it's every 13 months, if I'm not mistaken. So these are the times where you have to say, this too shall pass. If this doesn't pass, then you don't really have to worry about your stock market portfolio. Okay. But if it does pass and you're not buying in periods like this, then there's very low chance of outperformance over the long term. So yeah, you got to buy when it's uncomfortable. That's just the way it goes. They don't give away multi-baggers for free.
I got it. Okay. All right. Great Hill Capital. Tom Hayes joining us here, Stock Trader Network. Really appreciate the extended interview with you, and we'll get you back on again soon.
Thanks so much, Joel. Have a great one. And we're back. And then finally, I had the pleasure to join Liz Neo on CNA, which is the equivalent of the BBC in Singapore, covers all of Asia. And thanks to Liz and Blanche Martinique for having me on last night. You can listen in here.
And for more, we're joined by Thomas Hayes. He is chairman and managing member at Great Hill Capital. Thomas, so markets really whipsawed by the sharp moves we're seeing in oil prices. That comes amid mixed messages as well from Washington, especially on the Strait of Hormuz. At this point, how crucial is clarity about what the situation really is in the Strait for stabilizing markets?
Well, I think the market's telling you that there's more clarity than there was 24 hours ago. You're seeing data come from Goldman Sachs showing that there were actually a number of ships that got through the Strait of Hormuz. Many of them are turning off their transponders as they go through the Strait of Hormuz and then turning them back on several miles later. So you have that. You had the G7 meet today and acknowledge 1.2 billion barrels of reserves and a willingness to release up to 300 to 400 million if needed. They didn't have to release it today. Oil prices have really come off the boil. And to your point, this was something initiated. Trump could start it and Trump could finish it, very similar to what we saw last April with the trade war. And he indicated yesterday that he's way ahead of schedule and he would like to see this done sooner than later. You have the election factors. You have the fact that they're making progress quicker than anticipated. You have the fact that much of the Iranian Navy has been destroyed. Their launching of drones and missiles is down 90%. So that's why you're seeing a relative calm in the market. We did see, obviously, some bullishness when Energy Secretary Wright incorrectly stated that a ship had already been escorted by U.S. Navy, but that also remains an option. So we will get flow through the Strait of Hormuz. And President Trump indicated yesterday, if that is not the case, or if there is any interference, the level of decimation will be 20 times greater than they've ever seen in the past. And I don't think that's something that they want to elicit.
Yeah, still investors are trimming their bets a number of Fed rate cuts we could see this year, with the first they expect not coming until September. What will you be looking out for when the CPI figures drop later? I mean, with this conflict now front and center, which side of the Fed's dual mandate you think will take precedence this year?
This might be the least important CPI report in the history of CPI reports, with the energy and the war factor in the background, I do think we're going to get the cuts, but the market is concerned. There's no question the 10-year yield went up a little bit, because if this remains prolonged and energy prices remain elevated, that is the input cost for most goods and services, and that remains elevated, it's going to tie the Fed hands. That said, Warsh has indicated that they're less focused on supply shocks, and their inflation measures that they use are X energy. I think that's a tenuous argument because, again, energy is a huge component of input costs across all goods in particular. So I think the expectation of the market curbing their enthusiasm, expecting less cuts than before the war was initiated, is correct. The minute we see any ships getting through that Strait of Hormuz with regularity, with or without escorts, I think you're going to see those odds go back up because inflation will no longer be a concern. Furthermore, it's affecting private credit. As you've seen yields go up, the fear of private credit and refinancing goes up if there are not going to be cuts. If this is over sooner rather than later, I think you're going to see some reduction in the fears around private credit, which was rattling the markets in the weeks before the Iraq attack. So that's all a function of interest rates and expectations around the Fed, which I think will normalize once this is largely in the rearview mirror. And I would say, Liz, the most important thing with this war, even if the bombing and attacks continue for days or weeks or months, if ships are getting through the Strait of Hormuz from a stock market perspective, the war is over. I mean, as far as what the stock market will price, even if they're still bombing. So we're going to continue to watch those ships with transponders, without transponders, with escorts, without exports. That impacts energy prices. That impacts Fed cut expectations, private credit refinancing, and earnings and recession outlook odds. So a lot of things packed into that, but it all comes down to the Strait of Hormuz.
Strait, indeed. Yeah, and I wonder if it's too early to be talking about the likelihood of a recession this year.
Yeah, it's spiked up in the last few days up to 35% from, 20% or below 20%. I think that is a knee-jerk reaction. It's very tough to make the case right now. You just had Q4 earnings mostly reported, up 14% year on year. That was above expectations of 9%. You have Q1 earnings expected to grow 11%. You have earnings estimates for 2026 have been revised upward to 313, for 2027 revised upward to $365 per share from 363. So right now, all looks good. GDP now remains solid, remains in expansion, healthy 3%, 4%. Besson's talked even about 4% real and 6 or 7 or 8% nominal. So right now, all is well. If this is protracted, estimates will come down, but right now there's no real economic data to support any idea of a recession in 2026.
All right, sounds a bit positive for now. Thomas, appreciate your time. Thomas Hayes, Chairman, Managing Member at Great Hill Capital.
And we're back. Then some quotes of the week. Successful investing is about managing risk, not avoiding it. That's from Benjamin Graham. And then from Charlie Munger, I like the idea of using artificial intelligence because we're so short on the real thing. Couldn't agree more. Thanks to all of you who have been sending in pictures. Many of you have gotten tremendous value from this podcast over months, years, weeks, days, etc. And all that we ask in return, if you want us to keep doing this for non-clients, is to share it each week with one person you care about that's into the stock market and into investing. And a lot of you do that by ordering one of the hats or shirts or mugs, and people ask you about it, or the hoodie, which is my favorite. And you tell them, and they get into the fold and get tremendous value over time. So we're very grateful for that. Goldman's flood sees potential for extreme rally in stocks. I tend to agree, actually. I think we are setting up for a massive rally in the next couple of months, March and April. And what he's pointing to is, and I alluded to this with Joel, started by a tweet, ended by a tweet, reminds us of last year, but he's also talking to the short book being at the highest level since 2022. Total value near an all-time high at 300. Gross exposure. Short exposure now stands at the highest level since September 2022 data from the bank's prime brokerage team. That's huge. And, you know, it's funny looking at some of these names that we've discussed over the podcast and just looking at the opportunities, because it feels like, and I'm going to show you the difference between individual stocks and the indices when you're underwriting each business as if you are going to own the whole company. You're not worried about indices on a day-to-day basis. And that's why we always encourage you to zoom out. So we're going to go through some of these names on a monthly chart, just looking back so you can see what I see and how excited I am about the current portfolios and new people that have been coming in. You know, look at Advanced Auto Parts here. Yes, it's up big off of its lows, but you could see here, it's literally just getting started, forming that base to move a lot higher. And they've just been hitting on all cylinders, Shane O'Kelly, to get the margins in order. They shut down all the unprofitable stores. They paid down the debt. They're now reopening new stores in the markets that they're number 1 and 2, doing the distribution hub, copying O'Reilly, doing it right. And this is early days to a double plus. Boeing has rallied a lot off the lows. They're expecting a big order from China next month for 500. We'll see how much strength we get off that. You get towards a 3 handle, maybe, you know, some of this stock we bought at 140, 150, we'll start to see. But this is kind of early days here at duopoly. It's been a great mover for us, but in the scheme of things, it's pretty early. Then Alibaba, everyone's been concerned about the last few weeks. Just look at this thing. It's absolutely rocketed. If you don't expect this type of consolidation before the next leg, you are mistaken. So when you zoom out here, you see what's happening, and all it's doing is shaking out the stupid people who sold at 60, bought at 190, now got shaken out at 130, and this thing will rip back to 200 plus over the coming months and years, and we will continue to participate. Baxter, this one can't get out of its way. It's testing the lows here. This one's going to be fine. We've got the Danaher way, new CEO fixing things over there. Just go to any hospital. Every IV, every machine, everything that you use is part of this. The population's getting older. They're going to be just fine. Early days. So like you say, oh, the market's overvalued. Well, would you be interested in buying a stock that's down 75%, that the downside is protected, the upside's a triple plus, and all you got to do is play the time arbitrage game? And the answer is, if you know what you're doing, that's exactly what you do. Crown Castle, AT&T just announced that they're doing $250 billion of investment in their network. Crown Castle's the beneficiary. This is up off the lows. Early days for recovery. They sold off the non-profitable fiber business, pure play on towers. This is a mini moated kind of duopoly, oligopoly business, which we love, and we're going to enjoy that. Then Cooper Standard. You guys can't get out of your own way. The thing is up. Some idiot tweeted me, why is Cooper Standard down 30%? I don't know, maybe it's down 30% for you, but our initial basis is just over $5. So, you know, we're still up 600%. Leaving that aside, there were some private credit fears. They got all of that refinanced. That actually completed right after our podcast last week, and S&P upgraded them one level in their credit rating. They have nothing to refinance until the early 2030s. So game on, everything is in place as the volumes start to recover over time. And that's going to be a function of rates as Warsh gets in and tightens liquidity through the balance sheet and then eases through cuts. We love this story and just expect it to consolidate a little bit more, shake out a few of the weak hands who bought the strength after earnings. I'd love it to get down to the low 20s before going back, you know, back to highs here, 80, 90, 100 plus. But I don't think it will. But let's see what happens. I'd love to get some new clients in it. Comstock Resources. This has been a beast. Obviously rallied 8 to 31. Now it's consolidating back at 20 before it takes its next leg higher. We love this story. Diageo, look, people think they're not going to drink. They're doing 2.8 billion of free cash flow. You can't give the stock away. This guy who turned around Tesco is doing the exact same thing here. He's going to cut out all the fat. This business is going to be fine. People drinking less, drinking better. Emerging markets still flying. The non-alcoholic growing 40%. This is the leading player in the field. Disney, this thing has just been consolidating. It rallied off the lows from 85 to 123. Now it's consolidating. You got a new CEO. You got a new head of parks. Market's in a wait and see, show me. This is an unbelievable, unassailable franchise that is investing in the highest return on capital businesses with the cruises expansion, and this is going to continue to be just fine. Estee Lauder, you couldn't give the stock away at 50. Now that it's more than doubled off the lows, it's consolidating, and before it takes its next level higher. This was a play on the China recovery. It's starting to happen. They're doing a lot of things to increase margins online. We love this recovery story. We love the consolidation. I don't think it'll get low enough for us to buy more because we don't tend to buy up. We bought down, but in the scheme of things, you can see how this recovery is just beginning. Next, you've got Estee Lauder, record revenues, record free cash flow, consolidating here, new CEO, the show me story. She seems to be doing a good job. Her first quarter was great. We covered that a couple of weeks ago. We're comfortable here, and you can see here early days for a recovery. Generac had a huge move in the last couple of handful of months from, off the lows in the 90s to 200 and almost $240. Big play on the data center backup generators, and we haven't even benefited from the resurgence of the housing cycle, which is going to be a function of rates later this year. 80 some odd million millennials age 34, 35. They've been delayed by rates. Warsh will get the job done as this war gets wound down in coming minutes, days, weeks, or months. We don't know. That's going to be up to the guy who started it with a tweet. We'll end it with a tweet when he decides and when the job's done. Goose, record revenues, record free cash flow, great earnings, shot up off of that, consolidating with the war. All this nonsense creates an opportunity. We put some more stock on there. GXO, monster move off the bottom, doubled off the bottom to 66. If you remember, that an offer to take out at 60. I was very vocal with management that they should not be allowed to steal our upside. We got into this thing for 100 plus. They rejected the offer. They got the CEO in, which we had on our podcast, Patrick Kelleher. He's doing an incredible job doing everything he said he was going to do. This is early days for GXO. So you can see there's just an enormous amount of opportunity. Then we play the protein side of the GLP-1s with Hormel Foods. They've raised the dividend for 60 consecutive years. They're getting their margins back in play. This story is early days, and you get paid 6% while you wait with the dividend increasing. Intel was a monster for us, obviously more than doubled off the lows. We sold half, so now we're playing on the house's money. And we believe that Lip-Bu-Tan is going to execute on the advanced fabrication, and this could be 100 plus and beyond. And we intend to ride that. National Oil, well, Varco's been an absolute beast, almost doubled here in the last less than a year. Now it's consolidating those gains. This has a long, long runway. It's going to benefit from Venezuela. It's going to benefit from onshore and offshore rig expansion. Drill, baby, drill. Another 2.5 years of that theme and beyond. We are poised to continue to benefit. Pfizer just getting started. So you can see here, it's like, oh, the market's overvalued and all this stuff's going to crash. No, all the crowded stuff that was at ridiculous valuations that people were chasing the shiny objects that we warned and warned and warned last year and people kept doing, those people got destroyed. Okay, the average NASDAQ stock was down close to 30% year to date just about a week ago, probably more since then. Now those are poised for a violent counter trend rally, which, by the way, will probably last a month to 2 months, and then it will be sold into the election, which is when we'll be starting to buy tech for the first time since we bought in the hole in fall of 2022 with Amazon and Google and made very, very quick doubles on those two stocks. PayPal starting to recover off the lows. Enrique is in. He started on March 1st. They're already getting aggressive about costs, already getting aggressive about stock-based compensation, which has been a complaint of mine for years. He will do the buybacks. He will execute on everything. We love this. We brought our basis down to the mid 52s because of this, the stock selling off when on the surprise announcement. We love that opportunity. $6 billion of free cash flow, buying in 15%. And no one's paying attention to the ad business, which is going to add an extra $1.5 to $2 billion of free cash flow over the next 3 to 5 years. How do we know this? Because the guy who built the Amazon ad business, which represents 50% of Amazon's operating income, by the way, most people don't know that, is building it now for PayPal, and PayPal has more information than they did. And for when he built the $2 billion business at Uber, had probably 10% of the information that PayPal has from its 430 million users around the world. Papa John's, okay, $47 offer, insulting, but it is what it is. That'll either be rejected and then it'll fall back down into the high 30s, to the low 30s, where we can buy more for new clients. This same group offered $60 less than a year ago. The business has become more valuable with the turnaround. I would do a deal at 74, but again, I'm probably getting another $25 to $50 stolen out of my pocket. But in terms of IRR, since we've owned it for such a short period of time, double plus is acceptable inside that short period of time. Stanley Black & Decker, huge move off the bottom, 50 to 80. Now it's consolidating at 70. Everyone's getting worried about housing because of rates and private credit and all this stuff. Once the Iran thing's done, everything goes back to normal. And the rate expectations cuts come back because the inflation fears are gone. And then the private credit gets kicked down the road another 3 or 4 years. And those fears will go away. There will be some defaults here and there. They'll be more idiosyncratic. They'll all refinance and live to tell the story. And we'll deal with that in the early 2030s when it's a complete disaster and train wreck. VF Corp consolidating here on some analyst note, which is absolutely fine. I'd love to see it get down to 15 so I could get new clients into that one. For the long term, Bracken's doing everything he promised to do, deleverage the balance sheet. Everything's 75% of the business is back to growth. Vans is turning around. We're going to see that skateboarding shoes are in for this spring. They're going to be a huge beneficiary, and it's early days. And then you look at indices like VTI, which is a passive total market index. That looks extended, but on a company by company basis, there's just so much to do, which is why going into this year, we told you if you own indices, you are going to be underwhelmed with your performance. Mid to low single digit. I said it would be mid to like 5 to 7% on the indices, maximum, and under the surface, a tremendous amount of money would be made. And that would be the shift to the 493. Small versus large, international versus US. And we saw that up until the war. That shifted back. I think we're going to get tech and software have a huge counter trend bounce in the next couple of months, which is going to drive the indices. Those will be sold. Continue to buy defensives on weakness, and that will serve you well into the fall. Our game plan is playing out as expected. Ex-US, you can see this has gone parabolic, doubled off the 2022 lows. But if you consider how they've underperformed for, almost 20 years, this is a breakout. It'll probably back test and then really go into a long-term secular uptrend. This is the emerging markets VWO. That's that. X-ray, Dentsply Sirona, we're going to spend a lot of time on today. Super excited about that one. And as a result of all this opportunity, as you know, we open up once a quarter for those smaller accounts that can only start at 1 million to 5 million. So those are going to officially open on April 1st. If you want to get ahead in the queue, get your application in, take advantage and be ready to go and not get delayed with all the opportunities that we've laid out and more. You could either go to hedgefundtips.com, click on money management, enter your information there. While you're there, click on terms. This is all opinion, not advice. Or go to our new website at greathillcapital.com and you can read about us, get more details. ADV, etc., and click on money management, enter your details there. Now let's get down to business. We've got a lot of data to cover today. So here we go. This plots the spread between ISM new orders and production, which is a gauge for U.S. industrial momentum more broadly. This is turning up into expansion. This is from the destock to the restock cycle. So you're going to see all those companies dramatically start to improve. This is the amount of ships that got through the Strait of Hormuz as of the 9th. This was from Goldman Sachs, showing a number of ships getting through by turning their transponders off. We saw some more. It's spotty on a day-to-day basis, but that will get opened very quickly as all the allies have the same idea in mind. Let's get to some Sloomer technical stuff. You can see the S&P 500 came back and tested this support around 65.50. Maybe it needs to go down there and double test it. But it does look like it wants to bounce. And I think based on the positioning, maybe one more flush, but I would not be surprised if everyone gets surprised and we break out to new highs over the next couple of months, which would be on the low probability side of most people's bingo card. But based on positioning and the levels of fear, I think that's the more probable outcome. And it happens with one tweet or one strategic action that gets the job done. Advanced decline line got a little bit weaker. That makes sense after such a huge move for the last 3 months. NASDAQ, same thing, going down to test this support. Maybe it needs to spend some more time here, but my sense is we're getting ready for some type of an announcement or an event that's going to get us to the next level. Russell, this is a beautiful chart for those who are into that. 3-year cup forming base and handle, broke out, back tested. Now it's getting ready to rip higher for many years to come. The measured move would imply 900 points up to 3,400 plus. That will be a monster move that helps the gooses, the planet, the Papa John's, the Dentsply Sirona, the VF Corps. The smaller companies are all going to benefit from that. Here was the MSCI World, had this, again, multi-year consolidation, broke out. Does it go back and retest this? I highly doubt it. I think it's just going to consolidate up here and move to the next level. You can see the relative performance breaking out a long-term downtrend since 2010. This is going to be a multi-year play where international outperform U.S. equities. Europe may need to come back down here. Europe ex-UK has already done that breakout back test. So there's a lot of things to do here. Tokyo, some of these groups are going to move first. You're already seeing the software, which I told you we were going to get a strong counter trend rally. You're starting to already see that happening in some of the names. Hang Seng came out, retested. Maybe it goes back to this line. Maybe it's just at the support. I think based on Alibaba reporting on the 19th, maybe another 8 days of uncertainty, I think Alibaba's numbers will be just fine and or guidance. Here's the counter trend bounce in the 10-year yield on the war issue up to 422. Now it looks like it wants to resume its downtrend, which will help spring housing. And President Trump is not unaware that he does not have much of a leash. And that's probably why he timed it when he did. He's got to get this done now. And if he wants to win the election, if he wants to lose the election and be a lame duck for the last 2 years and get nothing done, then this should extend for another month or two and guaranteed to lose the midterm election. If he wants to be a hero, he'll do this, maybe quickly do Cuba, which will take 5 minutes, and then go into the midterms as an absolute rock star with Maduro, with the Ayatollah and the Cuba all tied up, completely checkmating all the communists around the world. So that's a big deal. Counter trend move in the dollar. That's going to resume lower over the coming months. The Canadians who were complaining about, Tom, when is you keep saying the loonie's going to go up. This has been a monster move off the lows, and it's early innings on the move in the Canadian dollar stronger. You guys are going to be smiling so wide you could eat 2 hockey pucks sideways, and we'll celebrate with you. Here's the euro. monster move, 20% move up since early 2025, consolidating those gains before the next up leg. Happy about that. I own some land in Europe, so that's good news. Euro oil futures, probably the quickest turnaround in history. We'll see how that plays out. Gold prices looks like they put in their top in January. Retesting this looks like a clear double top. It's hard to have two conflicting views in mind at the same time: dollar weaker over time and gold being done. But stranger things have happened. Copper here consolidating at the highs, and I think that's it on the Slumer stuff. Let's see. Tech. XLK resting here at consolidation, semiconductors resting here. So Intel start to take off again today. Semiconductor index, same thing. Avago, you can see a lot of these semiconductors resting, waiting to take their next move higher. Software, this is already starting its bounce that we predicted down here when people were puking it out. I think this will probably rally, back up to this 101. This looks like a good level, actually, before getting sold off with a head and shoulders top. We shall see. By the way, we make like zero decisions on the basis of these charts, but it's good to have a good view of the flows. Oracle had good earnings last night, so that's good. That'll be part of that software recovery. Banks probably need to bounce here. Payment services need to bounce here for sure. What else do we got here? Regionals, same thing. And energy probably is going to rest. I wouldn't be surprised if Varco takes a break for the next 8 weeks while everything else starts to rally. And same with a lot of these others. Boy, we got a lot of stuff today. All right, let's get on to the next. Alpha opportunity is at the highest level since 2020. We agree, meaning stock picker to outperform. Here's the emerging markets breaking out after 18 years. This is going to be years and years of outperformance, ladies and gentlemen. Record weekly inflow into energy funds, so they've got to rest now and punish the Johnny-come-latelys who weren't in November, December when we were pounding the table and chased up. ISM services PMI also in expansion. Here is the cycle, the kind of roadmap for 2026 that we've been talking to you about. We expect, we got the chop here in the first couple of months, which was expected, and now next move should be an aggressive move into mid to late April, higher, where we will likely harvest a couple of positions and go into the election volatility with some cash, possibly with some shorts and a lot of defensive longs like Staples, et cetera, that will do well when the market is getting roasted. And by roasted, I don't think we're going to get much more than 10 to 12% pullback, because we've had 20% plus corrections in the last 6 years. It's usually one every 4. So there's a lot of pull forward there. You got the stimulus with the tax checks. You got deregulation. You're going to have a relief rally when Iran gets resolved or declared to be resolved. And that's that. Next, we've got intra-year declines versus calendar returns. So you can see every year you usually get a 10 to 20%. Every year you get a 10%. It's basically every 11 months. And then, every few years you get the 20%. And every 5 you get the greater than 20%, scare the socks off you type stuff. Exploration and production. Maybe we hit some resistance here, pull back, but this will be a multi-year trend as well. We agree with that. That's why we own the Comstock and the Varco. Home relistings are on the rise. Delistings have soared in recent years, so now they're coming back on. Personal savings rate starting to go down. Shale revolution turned a quarter, making U.S. a net oil exporter. Now produces over 20% of the world's oil, largest share by any country in more than 55 years. That is exciting. Commodities versus stocks, just starting to turn the corner like we saw in the early 2000s. This is the beginning of a multi-year trend. Commodities are going to start to outperform. Probably need a little more exposure there. Hyperscalers realize year-on-year growth. This is why the imminent rally in tech and software will be sold. You can see here the free cash flow, year-on-year growth in free cash flow is negative 30%, now approaching 100% of operating CapEx as a percentage of operating cash flow, now at 92%, which means they could be negative, free cash flow negative by the third or fourth quarter, which is when you're going to get a few of them cry uncle and say, we are pulling back on the CapEx spend. Everyone's going to say the AI trade is over. And we will be buying up some of the best names in the hole when no one wants them later this year. So that's that. Labor market is not out of the woods yet. We agree, probably some more weakness there, which will give him more the space to cut. Remember, it's a dual mandate, not just inflation, but full employment. Weekly business formation exploding higher, driven by AI. That's a good sign to see. And unemployment duration picks up. Weight of top 10 companies in the S&P 500 starting to roll over a bit from 42% down to 37.8%. That's going to go a lot lower, which means those names over the next 12 months will probably meaningfully underperform rather, as we had been warning coming into this year. So this just shows the current performance to the stock market. Is sideways chop in the early year, rally into mid to late April, some weakness into the election, and then a huge year-end rally. M&A announcements are spiking. Consumer confidence started to tick up just a little bit of a hair. We've been looking at this from the standpoint of PayPal. We overlaid PayPal's chart on this from the standpoint of VF Corp, from the standpoint of a lot of the discretionary and restaurant stocks. When this turns, those will boom. This is now finally starting to turn. Lowest consumer sentiment since COVID. And then before that, the European debt crisis in 2011 and the great financial crisis in 2008. Before that, you got to go all the way back to the recession of 1990 and the Volcker hikes in 1980. And then before that, 1974. Record inflows into Hong Kong overnight via southbound Stock Connect. Recession odds have spiked up as the market has gone down. Opinion follows trend. That will be short-lived. JP Morgan on how Operation Epic Fury would end. Quote, resource risk will begin to outweigh increasingly marginal military gains, and the conclusion to the conflict will come down to the 3 M's: munitions, markets, and midterms. We couldn't agree more. I'm curious who the author was from JP Morgan on that, because I couldn't have said it better. I think he is spot on. Historical short interest of iShares 20-year Treasury bond ETF. So record short on that on the TLT, which implies massive rally in bonds, compression of yields, relative weight, increasing price. Hedge fund exposure to cyclicals is still low, but starting to swing higher. Sentiment is washed out here. According to Ned Davis Research, trading sentiment is super low. Healthcare valuations are historically low, so this theme persists. That will help the Baxters, the Dentsply Sironas, the Pfizers in months and years to come. Average refunds are up for most higher income households, 10% greater than they were last year on the tax refunds. So that will be offset if Iran drags on. If Iran gets done sooner rather than later, that is going to be a boom of spending. If you think it's hard to get a restaurant at a good reservation at a good restaurant now, wait till you see what happens in the next 8 weeks if this thing gets wound down and the refunds start coming in spades. Year over year rent growth is declining downward. And extreme oversold, as you can see there. U.S. home resales increase on improving affordability. Extreme policy uncertainty, historically bullish for stocks. 3, 6, and 12 months later, returns are anywhere between 10 to 31 on the 12 month. We talked about that in Buy the Bombs. 12 months later, there have been 41 U.S. overseas military strikes since World War II. On average, the market's up 12.9% 12 months later. As you can see, we are the least dependent on the Strait of Hormuz for energy imports. China has the greatest vulnerability at 50%, South Korea 65%, Japan 72%, India 50%, Europe 18%. We get 2% of our oil from the Strait of Hormuz, so we're best positioned for this situation. Performance and earnings of software stocks have diverged. Again, rip your face off rally coming to a theater near you. That will be sold by institutions that got trapped and couldn't get out. They will use that opportunity to get out in the next 2 months. And then when they're all gone in the fall, we'll pick up a few of them. All right. Mainland, well, it's a very hard sell for software. Probably not software, but tech. Some headlines. Mainland investors buy record Hong Kong stocks via the trading link. China consumer inflation beats expectations on holiday boost. China's annual economic plan highlights tech push, market stability. Alibaba sets up new task force led by Eddie Wu to focus on AI model development. Boeing close to a 500 jet order with Trump-Xi summit. If that pushes Boeing toward 300, we'll see where we are with that one. Boeing increases jet deliveries in February despite ongoing 787 seat headaches. Hopper scores Pixar's biggest original animated opening in years. Disney keeps crushing it on that front. Pfizer secures China nod for obesity drugs as generics loom. Pfizer's eczema drug meets main goal in mid-stage trial, plans late-stage study. February home sales rose after mortgage rates eased. First-time home buyers return to the market. For how long? Depends on rates. Back to the market. Relistings jump as home sellers bet on stronger spring market. Senate's new housing bill would force large investors to sell homes. That's the Innovation Homes and the American Home what's that other one? It's AMH or something like that. Within 7 years, I think it's a non-issue. The fact of the matter is the bill is kind of comical. These guys are not buyers in this market. They were buyers in 2009, 2012, 2014. They're sellers now. So this bill act is effectively when they want to be selling anyway. So it's a non-issue, but nice symbolically in a speech. IEA will launch largest ever oil release from global strategic reserves. So they announced 400 million barrels this morning. G7 says it supports use of strategic reserves to meet. Yeah, they did that today. Energy Secretary says tankers could start moving soon. Time will tell. Chevron, Shell closing in on first big oil production deals in Venezuela since U.S. captured Maduro, sources say. Look at all those rigs. National Oil, Varco. The race to seize on lower tariffs has businesses rushing in shipments. U.S. Customs Agency expects tariff refund system to be ready in 45 days. Collected $166 billion in tariffs from 333,000 importers. Readying a system within 45 days to process refunds on President Trump's tariffs that was struck down as illegal. It's interesting to see whether they will tie it up in court or if that money goes back into the economy. That could be a big deal. The inflection supports our call for decade high U.S. industrial growth into second half 26 and 27. We've been talking about that. GXO appoints Mark Suchinski as chief financial officer. He came from Spirit Aerosystems and the Geo Group. Fed will cut rates this spring if job weakness continues. It's continuing. 7 trends you're going to see everywhere in spring 2026. And what's the big one is classic canvas sneakers, which Vans is the leader. Clean Bill of Health stock market and sentiment results. This is our article of the week where we're going to update you on Dentsply Sirona. Reported solid Q4 results that were well received by the market, sending shares 15% higher as the new CEO, Dan Scavilla, continues executing on the turnaround playbook in his third earnings call since taking the helm. As we've said from day one, much of the heavy lifting in X-ray turnaround was carried out under prior management, which spent the last several years course correcting and stabilizing the business by taking $300 million of costs out through a 10% headcount reduction, a 60% SKU reduction, and consolidation across the supply chain and manufacturing footprint. While prior management got the house in order from a cost and efficiency standpoint, those efforts could only go so far. You cannot cut your way to growth. Fiscal year 25 marked the second consecutive years of sales declines, -3% in fiscal year 25, -4.3% in fiscal year 2024. To be fair, the dental sector is highly cyclical and just starting to emerge from a trough, but X-ray has still lagged peers in the recovery. That's exactly what Scavilla has been brought in to fix. He's coming in at what we see as effectively the 10-yard line of the turnaround with one job: spike the football and return the business to growth. The plan is centered on fixing the U.S. business, which is 32% of sales, which remains the primary drag on the portfolio, with sales down 12.3% in fiscal year 25, while Europe and the rest of the world have already begun to inflect back to growth. Scavilla is wasting no time making his presence felt, ripping the band off the Band-Aid with a multi-pronged plan aimed squarely at restoring profitable growth in the U.S. The turnaround playbook is built around a significant double-digit increase in R&D spend to accelerate innovation, stepping up from 4% of sales to the 5 to 6% range, a reorganized commercial team under new proven leadership, and the re-engagement and expansion of key distributor relationships with Patterson, Benco, Burkhardt, ADEC, etc., that prior management had cut ties with. And while we said the vast majority of the cost-focused heavy lifting had already been done, management surprised us with an additional $120 million of cost to be squeezed out of the business, savings that will allow X-Ray to fully fund the R&D ramp without any trade-off on the margin front. We won't have to wait long to see the plan start bearing fruit. Management is targeting sequential acceleration in the back half of fiscal year 26, with an inflection to growth in the U.S. expected in Q4. And importantly, that target is expected regardless of the broader dental market, with any improvement representing pure upside. That should set the stage for a solid return to growth in fiscal year 27 and beyond. While the market is warming up to the Scavilla playbook, consensus remains firmly in the show me mode, with growth expectations still depressed at just 2% from fiscal year 27 through 29. Even with the recent move higher, X-Ray is still trading at 50% plus discount to top competitor Envista, the widest gap on record, and one we expect to narrow. you can see here Invista trades at 18.8 times earnings, while X-Ray trades at 8.9 times. That's a 53% discount to Invista, which is the widest multiple divergence in history. X-Ray's own history tells the same story. Over the past 2 decades, the company has traded at 18 times forward earnings. Today, the multiple sits at just 8.9 times, leaving plenty of room for mean reversion. A couple of quarters of clean, consistent execution will go a long way for Dentsply, something that has been hard to come by over the past several years of operational hiccups. With the right pieces now in place, a new CEO running at full speed, and the business approaching an inflection point, it won't take much more than modest execution and improvement to drive meaningful multiple expansion as the narrative shifts away from the troubles of the past and toward where the puck is going next. At the pace Scavia is moving, we don't think investors will have to wait very long. We went through the earnings breakdown and put in stars next to the most important things. You can find that at hedgefundtips.com. Scroll down to most popular posts, and you'll see it there, a clean bill of health, stock market, and sentiment results. So you can go through that. Here are the top key points. X-Ray posted Q4 revenue of $961 million, plus 6.2% reported, plus 2.5% in constant currency, beating consensus of $926 million and bringing fiscal year 25 revenue to $3.68 billion, which was negative 3% and negative 4.3% in constant currency. So, I mean, fourth quarter was up 6.2% reported. They're getting a huge tailwind from having all those sales growth in Europe. 2.5% in constant currency. That's a big deal. And they also came in for the year at the high end of the range, 3.6 to 3.7 guidance range at the segment level. WellSpec Healthcare led the way with plus 6.6% reported, 3.9% constant currency, while orthotic and implant solutions remained the key drag, negative 12.6% reported and negative 13.4% constant currency. Q4 adjusted EPS of 27 cents, plus 4.9% year on year, came in slightly below consensus of 29 cents, with fiscal 25 adjusted EPS of 160, negative 4.6% year on year, landing in line with guidance. 2, gross margin came in at 46.2%, down 300 basis points year on year versus 49.2%, pressured by lower volume and a $15 million tariff headwind. For fiscal year 25, gross margin declined 160 basis points to 50% plus versus 51.6%, with similar drivers of lower volume and a $23 million tariff headwind. Adjusted EBITDA margin declined 10 basis points to 14.1% in Q4, while fiscal year 25 adjusted EBITDA margin improved 150 basis points to 18.1%. Looking ahead, management is targeting expense growth at half the rate of the top line growth, positioning the business for strong operating leverage as the recovery takes hold. 3, X-Ray continues to execute against its 24-month return to growth action plan introduced under new leadership centered on fixing the U.S. business, which is 32% of total sales. Management is planning a double-digit increase in R&D spend for fiscal year 26, stepping up from 4 to 5 to 6. As they look to accelerate innovation. On the commercial side, the reorganization of the U.S. sales team has already been completed, with new CCO Aldo Dente, a proven winner from J&J, bringing in Mark Bezjak, 20-year veteran from Zimmer Biomet, to lead the North American sales force. Management sees the unified commercial team as better positioned to compete, with the realignment already driving stronger field engagement and sales force investments expected to become increasingly key competitive advantage. X-Ray expects these changes to start bearing fruit in 3Q, with sequential acceleration anticipated in the back half and an inflection to growth in the U.S. targeted for Q4, regardless of market conditions. 4, X-Ray made progress in repairing distributor relationships during the quarter, re-engaging and expanding distribution agreements with Patterson Dental, Benco Dental, Burkhart Dental Supply, and ADEC, while continuing to advance discussions with additional dealers. Re-engaging the dealer channel is seen as a critical lever to broaden portfolio reach and improve go-to-market effectiveness in the U.S., with meaningful lift from these agreements expected in the back half, supporting stabilizing growth over the medium term. The structure of these new agreements has also shifted to a drop ship business model, a move expected to benefit both parties, with the goal of full adoption across all vendors by Q4. 5, management announced a restructuring plan and indirect cost optimization program targeting $120 million in annual savings to be redirected into return to growth initiatives. The program is expected to result in non-recurring charges of $55 million to $65 million, the majority of which will be cash expenses recognized in fiscal year 26 and 27. Key drivers of the $120 million in annual savings, including building a faster, more scalable, and profitable manufacturing and distribution network through resource consolidation, standardized packaging, and advanced planning and forecasting tools aimed at improving working capital and reducing product costs. 6, the announcement out of Q4Q was the elimination of the quarterly cash dividend, 5% dividend yield, freeing up $128 million in annual cash flow. We weren't surprised by the move and see it as a key out in the turnaround playbook, giving management the flexibility to redeploy capital toward debt repayment and opportunistic buybacks as early as late fiscal year 26 at what management calls bargain prices. We certainly agree. 7, free cash flow came in at $60 million in 4Q, up 66% year on year on the free cash flow versus $36 million the year before, bringing fiscal 25 free cash flow to $104 million versus $281 million the year before, with weakness driven by unfavorable working capital swing. Management has made it clear that free cash flow improvement is its top priority, expecting a recovery beginning in fiscal year 26, supported by a targeted 20% reduction in inventory, with the goal of returning business to the cash engine it has historically been. 8, net leverage remained flat Q on Q at 3 times, with $326 million in cash and equivalents against $2 billion in long-term debt. The vast majority of the debt maturities fall beyond 2030, with management committed to maintaining an investment-grade credit rating and prioritizing debt reduction in the near term. 9, with the search for a permanent CFO continues to progress, X-Ray appointed 3 new directors to its board during the quarter as part of the ongoing board refreshment, including James Forbes, former vice chairman of investment banking at Morgan Stanley, Brian McKeon, former CFO of IDEX Laboratories, and Don Zerbe, former CEO of Patterson Dental. 10, for fiscal year 26, management guided net sales of 3.5 to 3.6, with operational sales growth of -3 to -1%, excluding a -2.1% bite headwind and a $30 million one-time dealer capital equipment sell-through headwind. Management expects market conditions to remain relatively stable throughout the year, with any improvement representing additional upside and the return to growth in Q4 driven purely by internal execution. Adjusted EPS is guided to 140 to 150, with the midpoint representing a 9% decline year on year. Here are the earnings call highlights. We highlighted and underlined all the key points from the Q&A section and from the monologue at the beginning, which you'll find very valuable. Pfizer update on their earnings. Everything's kind of shooting on all cylinders there. And we'll go quickly through some of the top key points. Number 1, Pfizer posted Q4 revenue, -3% year on year operationally, but plus 9% if you exclude the COVID products, ahead of consensus of $16.9 billion. Full year revenue came in at $62.6 billion, which was up 6% if you exclude COVID products, ahead of prior guidance of $62 billion. So beating on those, margins expanded 340 basis points to 71.1 versus 67.7. I'm going to just touch on these so we can get to the Ask Me Anything questions. Recently launched and acquired products deliver strong growth, with portfolio growing 14% year on year operationally to $10.2 billion, helping to cushion the impact of upcoming products coming off patent through 28. Loss of exclusivity. Some of the key contributions include Padcev, which was up 22%, Abrysvo up 36%, and Nurtec up 13%. Biggest highlight of earnings season was the announcement of Pfizer's phase 2b Vesper-3 study results for PF3944, its GLP-1 receptor agonist added via the recent $10 billion acquisition of Metsera. Results were encouraging, with the experimental monthly maintenance dose driving up to 12.3% placebo-adjusted weight loss at 28 weeks, with no plateau observed, suggesting continued weight loss is expected as the study progresses through week 64. Pfizer also plans to use a higher dose regime in the planned phase 3 trial, with models predicting up to 16% weight loss at week 28, alongside a tolerability profile that is potentially best in class. The monthly maintenance dosing format is a key differentiator for Pfizer, reducing dosing frequency fourfold while maintaining efficacy and a favorable safety profile, a first for the industry. Management plans to advance 20-plus obesity trials in fiscal year 26, including 10 phase 3 studies and a highly differentiated potential oral formulation in phase 2, with Pfizer targeting the first series of potential approvals in 2028 in what they see as a $150 billion market. COVID revenue decline, no kidding. 6, Pfizer continues to build out its pipeline, $8.8 billion invested in BD transactions in fiscal year 25. Metsera and 3S Bio deals alongside 4 key approvals, 8 critical readouts, 11 key pivotal study starts. Looking ahead, management is targeting 20 key pivotal study starts in 26 in what they're calling a catalyst-rich year, with adjusted R&D expense expected to increase to $11 billion at the midpoint versus $10.4 in 25. Pfizer invests to maximize post-28 growth and strives for industry-leading growth by the end of the decade. 7, management continues to execute against its cost realignment program, exceeding 2025 targets, now on track to deliver the majority of $7.2 billion in total net cost savings by the end of 26, a full year ahead of schedule, with $500 million of those savings being reinvested to strengthen R&D productivity. 8, management returned $9.8 billion, or $1.72 to shareholders through quarterly dividend in fiscal year 25, a 6.4% annual dividend yield at current prices. Management made it clear they remain committed to maintaining and growing the dividend over the long term, while also maintaining $3.3 billion in remaining share repurchase authorization, with no buybacks planned for fiscal year 26. 9, Pfizer ended fiscal year 25 with leverage slightly above 2.7 times, expected to remain stable to slightly higher as the company navigates the loss of exclusivity period through 28. The planned sale of its stake in VIIV is expected to further strengthen balance sheet. When including the anticipated proceeds, BD capacity increases to $7 billion, providing additional firepower to further build out the pipeline. And 10, management guided revenue of $59.5 to $62.5 billion. Negative 5% to flat, broadly in line with consensus. Revenue is expected to be weighed down by lower COVID sales and a $1.5 billion loss of exclusivity headwind, which backing out implies 4% operational growth at the midpoint. Adjusted EPS is guided to $2.8 to $3, representing a 13% to 7% decline year on year, driven by the headwinds noted above. We've highlighted all the key points in the earnings call transcript that you can review at hedgefundtips.com. And again, congratulations to all the new clients that came in intra-quarter Q1 with larger sized accounts, and to those existing clients who upsized their contributions to their accounts. We will reopen to smaller accounts, the $1 million plus accounts, again starting April 1st. Those interested in going live on April 1st can begin the onboarding and application process ahead of time. To see if you qualify and to take advantage of this opening, you can either click on Money Management at hedgefundtips.com or at greathillcapital.com for more details. Larger accounts, the 5 and 10 million, can access bespoke service anytime. They don't have to wait until the quarterly openings. Earnings, transports, top 30 weights, last 60 days earnings revisions, revised up by 55 basis points for 2027 earnings were revised up 2.7%. On the retail earnings, top 30 weights, last 60 days, this year revised up 58 basis points. And for 27, down 11 basis points. Inflation numbers came in as expected, 2.4% year on year. Headline inflation. Earnings growth remains well ahead of schedule, over 14% for Q4 26, expecting 11% for Q4 25, 11% for Q4 26. Now, on to our exciting Ask Me Anything questions. Here we go from Loam Van Dam. Been listening every day since the Baba days. Azelis, AZE. Thank you for your long-term support. Looks like free cash flow is inflecting. Revenue's not. Share count went up a lot, though. From 2.3, 10 million shares. What did they do? All right. Specialty chemicals and food ingredients. I kind of like all these companies, to be honest with you, like the International Fragrances and International Flavors and Fragrances, Darling Ingredients. This probably is okay. Let's take a look here. I like the theme for sure. Let's look at the balance sheet. $309 million in cash, $600 million in receivables, $1.8 billion in debt. You got to find out when all that debt matures. Let's see. Free cash flow looks like it's inflecting. Yeah, I think that's worth doing some work on. Good job there. Let's go to Tim D. FICO. This is a software. So from a trading basis, you probably get a bounce here. I don't know if I want to own this long term or not, because I'm not sure how quickly it can be disintermediated. So for that reason, I'm a pass. This falls kind of in the software category, which makes me a little nervous. Nothing in the fundamentals that really implies that yet. As a matter of fact, everything here looks pretty good, but not the type of stock that we're interested in here, even though it might go up. Marcel Bala, Evonik Industries, EVK. $23 stock down to $13 stock. Revenues have really declined a lot. So it's cut in half. What do they do? Is this a chemical company? Yeah, chemical company. I like the theme. So you're probably okay. It's worth doing some work on. It's going to be a bumpy ride until these things finally turn. You just got to make sure you don't get stopped out with either lack of cash flow or an unhealthy balance sheet. So this has got $700 million in cash, $2 billion in receivables, and $3 billion of debt. So check and see when all that debt matures. Make sure you don't get stopped out. Joe Oshwald, do I have any thoughts on the buyout deal on pizza? Yeah, it's too low. Sharpen your pencil or take a hike. Divis Lung, I didn't get into Papa John's for $47. I got into Papa John's for, 70, 80, 90, $100 plus, depending how they execute. And I think we'll get it. But these guys could come in if they're smart. They'll raise their offer and they might steal it for $65, $70, in which case, it's double and it's fine. Although we might get short-term capital gains on that, which would not be good. But by the time they close, we'll probably have long-term capital gains. So that will be fine. My guess is they don't execute, and this thing will take a few years to be a double and beyond, and that's why we got into it anyway. So if they don't, if the deal falls apart, Trade Desk, same thing, falls into the software category. I'm not interested. I think it'll probably work in the short term. Josh, Universal Logistics, ULH. This is interesting. There's only one logistics company for me that tugs at my heartstrings, which is GXO Logistics. But let's take a look at Universal Logistics, because I think they're going to benefit from the same trends, although they haven't turned cash flow positive yet. So for that reason, I'm probably going to pass, even though this thing is going to bounce and it looks good on a technical basis. I mean, let's see, because if the balance sheet's okay, 37 million of cash, 343 of receivables, and $700 million of debt. Yeah, just not showing any sign of cash flow positive yet. I think it's definitely going to bounce on a technical basis. It's probably not one that we would own, but I definitely see the cycle turning and benefit. Professor Trump, could you, Jimmy Jones, prediction on the Trump and Xi meeting will finally be blue sky for Baba? I think it is. I think Trump wants a win here, but that's not why we own the stock. Sasha B, what's your view on BON in France? BON. Reason we generally don't like French and German companies is because of the labor unions, and it's impossible to fire people. when you have to cut costs. So it doesn't really help on the turnaround situation. So let's see here. Plant-based food. Fresh vegetables and packed foods. It's been around since 1853. Balance sheet, 23 million in cash. It's a tiny business, 400 million in receivables. Those receivables have jumped up quite a bit. Let's see if that's on a big commensurate jump with sales. $400 million in debt. Revenues haven't jumped, but the receivables have. Could just be a timing issue, but this is pretty leveraged. You got to just get comfortable with the. It's probably a family-owned business too, so that's interesting. Look like it's slowly improving. You'd have to do a lot more work on it. I think there are higher and better uses of capital, but let me just see here. I think you're probably okay for the long term with this one, but again, you got to really check the balance sheet. I mean, the revenues have been pretty down. But it does seem pretty cyclical. This was a more pronounced cycle than the past 3 or 4. It's probably the time to buy this thing for the long term. Just get comfort with when are the debt maturities on the balance sheet. Brian Ong. Hi, Tom. Been an avid watcher for more than a year now. Shared it with my family and friends. Thank you. First AMA question. The machines, intelligent investor. History is never static. Always updated. Yeah, he's asking, how do I predict the future? The answer is I don't. I bet on kind of sure things that I can have comfort in what the business will look like 5 and 10 years out. And that's why we avoid those things that can change very rapidly, like software. And that's kind of how I avoid that risk. Eric C., regular listen for a couple of years. Thank you very much. Gruge, I love the investment approach. If you're gonna go to get a master's, I would probably do an MBA over an MS AFA, or I would just do a CFA. But I think you should go. I guess if you got in, go. Columbia's great, and congratulations, Alejandro Bustamante. Please review Royal Unibrew. I don't even think that's going to come up on this. Royal Uni Brew. All right, let's see here. Yeah, the good news is everything's improving. The bad news is it's up 50% off the lows. So I think you're kind of late. Buy it when no one wants it. JD, probably okay over the long term, but all right, this is a really good question. Appreciate all the research. Referred many of my friends in to your podcast. Thank you. I have one ticker, RPD Rapid 7 Cybersecurity. Is there any bounce left with it software bounce, or it's just dead and would not correlate with the bounce. Thanks for all you do. This one's really tough because if you put a gun to my head and you said you have to buy software for this bounce, I'd probably lean towards cybersecurity. And, this one, the problem is it's a growth story that's now become a value story. Share count has increased. They pay themselves obscene amount of stock-based compensation. So they are kind of thieves stealing from their partners. That said, they're generating a lot of cash, and this stock is just completely left for dead. So I do think you could play this one for a bounce because the balance sheet is generally okay, if I remember correctly. Cash flows there. It's just people are questioning whether they're relevant. If you look on the Reddit boards, etc., their software is relevant, but encroaching competition from the bigger players. But it's just gotten oversold. You do have a JANA Partners in there as an activist. They probably got a basis at $30, so they're going to have to do something with it. So I think if you have to be in a software stock, this one could certainly work for a big bounce. And I'll leave it there. Next, Alejandro Bustamante, Yeti. Yeti is a tough one because the number, this one has been brought up many times over the years. It had a rally off the bottom. I would want to see this go lower. The key is, how do you get growth from a product like this? It's non-consumable. How many coolers are you going to buy every year? But, it just has a high return on capital, high margin business, revenues keep growing, free cash flow is okay. I mean, I think, below 35 if you want to buy it for the long term, but you got to really understand the growth story. I just could never, despite the good financials and the low price relative to those financials, I could just never get confidence in what does the business look like 10 years from now. It's kind of like Tupperware had this incredible business, and then Rubbermaid came along and it's like they weren't relevant. Now you could say, no, this is the, blue collar Birkin bag. You walk around, you go to the football game with a Yeti cooler and you look rich and you have your F-150 truck and all that stuff. It's all good and it's a good product. I have a Yeti thing, water thing for my golf bag just because that's the only one that fits in the hole in my golf bag. But I don't think you'll get hurt with this. I just don't see how you're going to get doubles and triples. So if you can tell me what the growth story is, I'll get more interested, but I just can't find it. So you could say international, blah, blah, blah. Okay, ConMed. This is from Aaron Lawson. Aaron. Oh, Aaron. This might be a good one. I think I like this one, Aaron. It's healthcare. It checks all the boxes. Let's see what the balance sheet looks like. 40 million of cash, 247 million of receivables, 800 million of debt. So a little levered on the balance sheet. Find out when the maturities are. Cash flow is a beautiful thing. They did 150 million last year. It's a low return business, but it's down 65, 70%. And what do they do again? Medical technology develops, manufactures, sell device, medical devices, orthopedic surgery. So these are all down because they don't know what the spend is going to be from the government, and they're all delaying expenditures. But eventually, it's kind of like post-COVID when they had to do all of the procedures all at once. I would just do your best to figure out that, their core sellers still have relevance. And if that's the case, I think you got a decent margin of safety here. And I think you probably found a decent one. Joseph Gaskin, good job. Ackman's IPO, no view there. I wouldn't buy it. Carter, Crowell, Step, STEP. But I wish him luck. I think he'll probably get something done because he is a doer, and I wish him success. Stepstone, I don't think so. Let's see. Shares going up, cash flow going down. Venture capital firm, especially in no. This is the worst thing. No. Thank you for tuning in. Rob Salem, SGRY. We don't need no alibi. SGRY. Surgery Partners. Yeah, well, I don't like this. They must have done acquisitions. The share count's doubled. I would just double check this share count. Did this happen because of acquisitions, and were they giving out stock when the stock was high or low? Looks like they jumped between 2001 and 2003. 21 and 23. So they did give out the stock when it was high. So that's pretty intelligent. What do they do here? Network of surgical facilities and ancillary services, ambulatory surgery centers. Yeah, this is such a tough business. I mean, this is all about federal spending. See what the balance sheet looks like. For me, it's a no, but I think it'll work. 239 million. Is there no debt on this thing? No, there is. 2.7 billion of debt, 239 million of cash, 602 of receivables. Is that debt secured by assets? Yeah, 1.4. Find out what was the reasoning behind that huge jump in share count. If it was for all stock-based comp, then dump it. They're animals. If it doesn't look like it. It looks like it was done for a deal, and they gave it out when the stock was high. I'm not going to kill them for that. Check the maturities on the debt. I think you might have something there, Rob. I don't think it's going to turn around as quickly as you like, but you probably have a little bit of margin of safety. Geo Group, is this the jail thing? Geo. Yeah. They managed to jails for the government. This is always a business model depending on the kindness of strangers, aka the government and taxpayers. Turn free cash flow negative. I don't think I want to be in this business. Secure. Wait a second. Tell me you don't manage jails without telling me you don't manage jails. Geo Group is a leading diversified government service provider specializing in the design, financing, development, and support services for secure facilities, processing centers, and community reentry centers in the United States. I think they run jails, although you couldn't tell it by the way they describe themselves. But anyway, you're not going to get a double or triple on this. I think it's dead money. You might trade it for a bounce. Learning a ton on your pod. This is from Alex S. CarMax. I don't like these businesses. KMX. All right, it's gotten cheap enough that it's starting to look interesting. So it probably works. Let's just make sure you can't get hurt. And if that's the case, then you probably make some money off of this. Just turned free cash flow positive. Revenues have been down the last 4 years. That makes sense because used cars were huge in 2021. Low return on capital business, FYI. So I don't know why you really want to be on this. Share count's coming down. Let's take a look at the balance sheet. I think this will, average car on the road 14 years. You need lower rates. There's going to be a lot of incentives that you're fighting against with new car incentives as rates come down. So be wary of that. 204 million of cash, 150 million of receivables, and $16 billion of debt. It's probably against the land, but I'm only seeing 6.7 billion. Seems like a pretty leveraged balance sheet. 3 billion of inventory. I don't know about this one. I think it's going to work. It's too much leverage for me, and I don't like the general business. So it's a no for me, but I can definitely see it work in a turnaround story as rates come down. Brendan G, thoughts on Cali? I think it's doubled off the bottom already. I think you're a little bit late. Oh, Callaway Brands, no, it's a terrible business. I know they've gotten rid of Topgolf, but no, I like the product. I don't like the stock. Justin Huffaker, Diageo, we own DEO, not the other one. Next one is Matthias. Watched 100 episodes. Oh, he's asking about BTI. I think you're late on that for British Tobacco. Yeah, I mean, you're not getting a double. You might get a dividend, but you're totally late. But welcome. Robert Y, H&R Block. Yeah, it's a value trap. HRB, I don't like this. You might get a bounce for tax season, but I don't need all these words. It's a value trap. Alexis, Polycarpio. Pinterest is one that I would have bought, but it's, again, we don't really do software and this type of thing. I know that Elliot got involved. I think everything about it, and we've covered it on the podcast. From a financial standpoint, it looks good, but it's not for us. And there's too much overlap between, we have Etsy, we have Alibaba in terms of just like overexposure to the sector. I never understood that business, but the financials looked good to me. But all right, so here's T. Lee asking, was the time to sell Baba at $190 before they announced a large CapEx? If you bought at $190, yeah. If you bought with a blended basis of 82, we started buying 100, bought at 80, bought every share we could get at 60. So at $82, we don't care that it's 135 now because it's going back over 200. If you care about the short-term fluctuations, yeah, in hindsight with 2020, you should have sold at 190, bought back at 130, sold at 250, bought back at 220, sold at 300, bought back at 250, but no one's that smart, and it's the wrong question. Jonathan Lansborough, what are your thoughts on Auto Trader, AUTO.L? Wow, this thing's got smashed. This looks like a CarMax of wow. This looks like the CarMax of the UK. Automotive platform provides vehicle advertisement on its website for private sellers as well as insurance and loan finance product. Yeah, this is like I don't love these because it's like car gurus where the financials always look good, but it never quite works. It's just not the type of business I want. I can't find any flaw in the financials. I'm just saying I generally avoid that business. He's asking about the music at the end of the podcast. We bought the rights for the song, but like every week YouTube would block us saying that, you know, this, you don't have the song. And we tried to tell them we do have the song, and we just got tired of it. So we just read the disclaimer at the end. Sorry about that. I like that music too. Thank you. You know, there's only so much time in a day. Like I can't argue with these people for 6 hours about this stuff. So I just dropped it. Thanks for all you do. Framework has helped me significantly and grateful. QDEL, QDEL for Mr. CJ Tux. All right. No inflection yet, CJ. Share count keeps rising. Cash flow keeps falling. I don't like that at all. Wow, this thing's gotten smashed. They must have done a dumb deal here. Like so many in 2022. Let's see here. Diagnostics testing solution, labs, transfusion medicine, diagnostics business, transfusion business. 170 million in cash, 2.5 billion of debt. Yeah, that's not good. Let's see something here. All right, so they must have done a deal. Yeah, they did a deal. They gave away a lot of stock when the stock was high. That's smart. Okay. So they can live another day. Was it related to stock-based comp? Yeah, they were a little piggy on the stock-based comp too. That's not good. I don't know. I feel like, I mean, this has been a business that's been around forever. I just don't know about this balance sheet. You got $500 million of receivables. So I would just spend some time figuring out when all this debt comes due. Because what you don't want them to have to do is raise a lot of equity by issuing shares. And what is this financed at? Is the debt servicing going up or down, assuming they can refinance it? So the answer is a hard maybe, but a little shaky on the balance sheet. Drew Robinson, TripAdvisor. I don't like these. These are the type that are going to get smoked by AI. It's like, why does this need to exist anymore? Like, there's 80 of them. I mean, when's the last time you went to TripAdvisor to buy anything? Maybe. It's not for me. I'm going to pass. DEC stock. I just don't like the business. It could probably work for a trade, but I just don't see why there's a reasons for existence. Share count just keeps going up. I don't like that. DEC. I'm going to pass on that one. Daniel Cap. Discovered your podcast a couple weeks ago. Enjoyed it a lot. Well, thank you and welcome. Grateful is available. Blah, blah, blah. Vistry, a British home builder. We don't want the builders. We want the arms dealers. That sell the parts to them. So the building supply, like in the US, it would be QXO and those type of companies. So this is a problem. I mean, they've doubled the share count. So this is, let's see if they did a deal. If we can see the revenues jumped, would have been in 2020 to 2023. They must have done a deal and given away stock. Let's take a look at the balance sheet. $500 million of cash, $1 billion of receivables, $600 million of debt. They're not pigs on the stock-based comp. I don't hate this one. I got to be honest with you. I think this one is probably worth a lot more work. And you've only been watching for 2 weeks. That's damn impressive. Daniel from Germany. Good work. I think that one should get some more work done. Jay Apt, Omega Flex. Ooh. What do these guys do? Flexible hoses, fittings, accessories. I think we looked at this one already. Yeah, I kind of like this one. This was given by a friend from London. I think this one's probably okay. All right, they got 50 million of cash, 14 million receivable, no debt. Free cash flow 17 million. Revenues have been down because of building. Shares outstanding are the same. Stock-based compensation is reasonable. So, yeah, that's really interesting. So I would just do some work to understand, like, did they have some specialized moat during this 2012 to 2020 period that they lost and their moat was breached by competition? Because, you know, it seems like they make, well, let's just see their margins, actually. That'll tell us a lot about that. Gross margins have been declining a little bit. No, I mean, it's not too bad. $61, it's kind of held in there. So if you can get confidence that this is just a cyclical issue, flexible metal hoses, fittings that are flexible gas for residential and commercial buildings, containment, corrugated power for hospitals. This is where they've probably gotten hurt. Hospitals, physician, veterinary labs, I kind of like this story. I really do. OFLX, no change there. I think it's going to take a little while to build a shareholder base, but after, falling this much, but I think long term, if you can stick with it for 5 years, 3 to 5 years, I don't see why you wouldn't get a double or triple on this one. I kind of like it. Wow, a lot of good stuff coming in on the AMAs this week, ladies and gentlemen. Luke Johnson, love your videos, blah, blah, blah. Authentic, thank you. What you see is what you get, guys. And Dell and Wix. All right, Dell, you never want to bet against Michael Dell. He always figures something out. The problem is you're already paying for it. It's up 10x, 13x off the bottom. So no for us based on what we do here. Wix, maybe this is a software commodity player to make websites like GoDaddy. They've all been hit. I'd probably be more inclined to own GoDaddy over Wix, but I don't think I'd want to own either of them. Wix is, let's see. Well, Wix might not be that bad. Let's take a look here. Cloud-based web development platform. I mean, the problem is like my friend Damien sent me, like we made the website. We hired someone to do the Great Hill Capital website. He sent me a website in 5 minutes that he made on Claude, which was probably better than the one that I paid for. So it's like, I don't know. Is Wix going to be relevant in the future? The market's saying it's afraid that it's not, but I think this is going to bounce with the software. So you got it at $90. Maybe it bounces back to 175 before rolling over. I don't have a good answer, but I can't determine. If you say, Tom, what's this business going to look like in 5 to 10 years? Looking at the financials, I say everything's fine. There's nothing to worry about. I mean, looking at the business that they're in, I say I have no idea. And for that reason, I'm out. But if I can't find anything wrong with it other than I can't have any idea what that business is going to look like in 5 to 10 years. So for me, I'm out. UPS CEO Carol Tomei stepping down. Do you like the stock with her finally gone? And then he has a comment, PayPal pushing PYUSD payments to be used in B2B logistics and shipping, sidestepping traditional banking rails. Company claims will reduce settlement costs by 90%, grabbed a boatload in the 40s. Thank you, sir. Yeah, great. I mean, that's just one more thing that's not priced into PayPal, free call option on the future. I do like UPS with a new CEO. I don't like buying it right here because it's already had a huge bounce. But below 90, I'd get interested again. This is not a high priority, but I do like the fact that we have a new CEO coming in. And Luke Wheeler, Phototronics, PLAB. No, we don't buy up. So with that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now. Pause your video player to review our terms and disclaimer. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Great Hill Capital LLC or PPI is not under any obligation to update or keep current the information contained herein. Great Hill Capital LLC or PPI and its respective officers and associates or clients may have an interest in the securities, derivatives, or entities referred to in this material. Great Hill Capital LLC or PPI accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.